What if you could profit when the market sells off and then profit again when it bounces back? Most traders only play one side, but a unique option strategy allows you to capture the move down and the recovery up. Hi, I'm Mike Bellafiore, co-founder of S&B Capital, one of the top proprietary trading firms in the world, with traders who earn 7 and even 8 figures a year. If you're serious about learning how pro traders use options to gain an edge, you're in the right place. Let's get to it.
Tariffs are back in the news in a big way as the U.S. administration's deadline for tariff negotiations has passed. And with very few new trade deals actually having been inked, the administration is now simply imposing steep tariffs on the majority of countries, which of course means that volatility is likely to return to the markets. And with the Qs, the basket of stocks representing the tech-heavy NASDAQ 100 index, having hit its most recent all-time high at 57.20 just a few days ago, it wouldn't be too crazy to think that the Qs might stage a little bit of a pullback here. But at the same time, this market's been so strong that it's hard to bet against it. And so one of the great things about options strategies is that there are ways you can make a lot of money if you're right and the market pulls back. But if it never pulls back, and I know this sounds crazy, you'll still make money, just not as much. And even though that may sound impossible, I assure you that it's not. And today's video is about how to set up a trade that makes a little bit of money if the market simply keeps rallying, but makes a lot of money if there's a pullback. So if that sounds like something you want to learn more about, then stick around, because I think you're going to be amazed at the details of this strategy, which we're going to walk you through step by step. Now, before we get into the option strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And so click on that video, which is appearing now on your screen right now, and that will lay the groundwork for you to understand the strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so to draw an analogy to the current situation, let's head back to December 16th of last year, 2024. And as you can see, the Qs went on quite a run over that previous year, hitting its then all-time closing high of 538.17 on that day. And you also notice the RSI oscillator, which is utilized extensively by professional traders, has pierced through the key overbought 70 level, closing that day at 71.16, which is often a sign that a rally is coming to an end. A scenario that, of course, doesn't always occur, but normally it does, and the subsequent sell-off can frequently develop over a period of a few months. So you shouldn't think of it as necessarily an immediate signal so much as it is a signal that a reversal may be developing. And so let's say that on that day, you went ahead and pulled up an options chain that expired 3 months later on March 21st. And focusing on the put side of the chain, you went ahead and bought a 525 strike price put option, about 13 points below where the Qs were trading that day, for a price of $12.99. And at the same time, you sold 2 of the 495 strike price puts, 30 points lower, for a price of $6.76. Well, when you do that, buying a put option higher up on an options chain and selling 2 put options lower down on that same options chain, when you do that, you're entering into what options traders refer to as a put ratio spread, which is a great trade to use on a stock where you think it's overbought, but your outlook on owning the stock long-term is bullish. And so you'd be happy to own it at a lower price. It's important to focus on the cash flow of this trade because it has important implications, as you'll understand a little bit later. And so starting with the 2 puts we sold at the 495 strike, those were sold for a price of $6.76. But remember, each put option represents rights related to 100 shares of stock. So you multiply that by 100. And you sold 2 of them. So you multiply it all together, you end up with cash flow of $1,352 for selling those puts. But simultaneously, we also bought that 525 put for $12.99, which, using a similar calculation, you can see results in a cost to us of $12.99, which therefore means that net you receive $53 in cash when you first enter into the trade. Now, we're going to come back to the significance of that a little bit later, but in the meantime, you should take note of another fact, which is that you're going to need to have cash in your account in the amount of $49,500 should you be required to buy 100 shares of the Qs at a price of $4.95, which is a possible scenario if you trade this strategy the way that it was designed. Okay, so now we've entered our positions and we've collected the $53. So let's move to the day the trade expires 3 months later to see how the trade turns out at that point. And as you can see, after an initial period of kind of chopping around in a tight range, the Qs began to sell off in mid-February as the fear of major disruptions to the world economy resulting from U.S.-imposed tariffs began to grip the markets. And so on that date, the Qs closed at 480.84, a price you'll note is below the location of the two short puts at 495. And so the way to handle this at this point is to sell off at the end of the day that 525 put, which is ballooned up to a price of $44. And you'll also buy back one of the two puts at that 495 strike, which has also increased in value to $13.95. But you're going to let that other put, the one you didn't buy back, you're going to let that one expire, meaning that you're going to be assigned 100 shares of the Qs, paying a price of $4.95 per share, because that's the strike price of the remaining put that you allowed to expire. And so at this point, your options trade is over because you've closed two of the three original options and the third one's been assigned. And so to be clear about the status right now, the options trade profit calculation starts with the $53 of cash flow. We add to it the $4,400 we received for selling off the 525 put, while netting that down for the cost of closing the 495 put for $13.95, resulting in an options profit of $3,058. And at the same time, don't forget that you've now also invested $495 per share for those QQQ shares, which comes to a total capital expenditure of $49,500 as well. And now you can understand, by the way, why we mentioned earlier that you might need that amount during the course of the trade. Okay, so now let's move to earlier this week on July 7th. And as you can see, after initially selling off further as the tariff fears hit their peak, the Qs then began to bounce, closing at 552.03 on July 7th. And so if we would have sold our shares on July 7th, then our total profit would be the total we collected selling the shares, minus obviously the cost of those shares, plus the profit we made back in March when the options trade closed, that options profit, which as you can see from the calculation comes out to a total all-in gain of $8,761. Before I wrap up, I'd like to make a very important point so that you can understand the power of this strategy. You see, instead of having executed this options trade in the first place, if instead on that day in December of 2024, when the stock was trading at 538.17, suppose that instead of implementing this strategy, we just bought the shares, then sure, they would have appreciated, but the total profit would have been $13.86 versus the profit of $87.61 we made because we used the put ratio spread strategy, a six-fold increase. And of course, the reason that we earned so much more was first, the fact that we actually made a profit from the pullback, as you saw when we closed the options trade on March 21st. And very, very importantly, we lowered the cost basis of our shares when we did buy the shares, when they were assigned to us at $4.95. And so when the shares bounced, our original cost was so much lower that our profit was much greater. And I haven't even yet mentioned another cool feature of this trade, which I'd like you to think about. Remember, at the outset of the trade, we bought the 525 put and we sold the two 495 puts, right? And so if you think about it, had the pullback never come, then all of those puts would have simply expired with no value on March 21st, because puts have no value if they're located below the closing price of the stock on the day the options expire, meaning that the result would be that you just keep the $53 that we received at the first outset of the trade. No harm, no foul. Even though our pullback premise proved to be wrong, we still made at least a small amount of money. And so what I'd like you to take away from today's video is that you don't have to be a sitting duck if you have a concern that a pullback is coming. Instead, you can actually harness the power of the pullback through the use of the put ratio spread strategy. Because you actually made a realized options profit on the pullback once you closed the trade near the close on the day the puts expired, allowing that one put to get assigned at a price that was quite a discount from where the shares were trading when you first initiated the trade. Because of that, you also profited, crucially, from the great price you were able to buy the Qs for on that day through the assignment of your put at a price of $4.95. So that once the stock rallied, your cost basis was way, way lower. And in fact, it's not at all uncommon, like it was in this case, that your larger profit comes from the fact that your trade put you into a position of buying the shares so much lower, on top of the solid profit you, of course, made on the options piece of the trade. Professional options traders are trained to understand these kinds of maneuvers that allow you to benefit from both the sell-off and the subsequent bounce. And now you're equipped with enough knowledge to seek out opportunities like this for yourself if you find them.
3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction. Then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.